$850 billion. On the surface, it's just a line item on a balance sheet. But in the hands of a strategic rival, it becomes a geopolitical weapon more potent than an aircraft carrier group. We are currently witnessing the dismantling of a 40-year financial truce. China, the second largest economy on earth, is not just walking away from the US bond market. They are effectively issuing a margin call on the American standard of living. For decades, the global economy ran on a simple engine. America bought goods, and the world bought American debt. That engine has stalled. We are moving from an era of risk-free return to an era of return-free risk. Today, we are going to expose the mechanics of this great decoupling, analyze the plumbing of the bond market that is currently flashing red, and explain why the 30-year mortgage rate is about to detach from the Federal Reserve's control. This isn't just about finance, it's about the math of survival. Welcome back. To understand the gravity of what is happening in the global bond market, we have to look past the headlines and into the plumbing of the financial system. Most people assume that interest rates are set by a committee of men in suits in Washington, D.C. This is a dangerous misconception. The Federal Reserve sets the overnight rate, the very short end of the curve. But the market, specifically the supply and demand for sovereign debt, sets the long-term rates that dictate your mortgage, your car loan, and the solvency of the U.S. government. For 20 years, we had a guaranteed buyer for that debt, China. They recycled their trade surplus into U.S. treasuries, keeping our rates artificially low and our consumption artificially high. That deal is dead. The data is irrefutable. Beijing is dumping U.S. paper assets at a pace we haven't seen since 2015, and they are replacing them with hard assets that cannot be sanctioned. This creates a supply shock at the exact moment the U.S. Treasury needs to borrow record amounts of cash. It is the perfect storm of fiscal dominance, and it creates a dilemma where the Fed must choose between destroying the dollar or destroying the banking system. Today, we're going deep into the data to show you why this $850 billion exit is the catalyst for a total repricing of global assets. To truly grasp the magnitude of this shift, we must first audit the numbers. Financial media often cites a single figure, China's holdings of U.S. treasuries. According to the Treasury International Capital (TIC) data, this number hovers around 760 to 770 billion, having fallen from a peak of over $1.3 trillion a decade ago. But this is an incomplete picture. When you aggregate the debt of U.S. agencies, government-sponsored enterprises like Fannie Mae and Freddie Mac, the total exposure Beijing holds over the American credit system swells to roughly $850 billion. This is not passive savings, this is leverage. For nearly a generation, the relationship between China and the United States was defined by a symbiotic loop, often referred to by economic historians as chimerica. The mechanics were elegant in their simplicity. The United States provided the consumer demand, purchasing vast quantities of electronics, textiles, and machinery. China provided the manufacturing capacity. In exchange for these tangible goods, the US paid in US dollars. However, instead of converting those dollars into other assets or currencies, China recycled them back into the US financial system by purchasing treasury bonds. This act of recycling was the linchpin of the global economy from 2001 to 2018. It accomplished two strategic goals for Beijing. It kept the yuan artificially weak against the dollar, ensuring their exports remained competitive, and it allowed them to build a massive war chest of foreign reserves. For the American consumer, this was the greatest financial subsidy in history. By acting as a massive price-insensitive buyer of U.S. debt, China aggressively bid up the price of bonds. In the bond market, there is an inverse relationship that you must memorize. As the price of a bond goes up, the yield or interest rate comes down. China's voracious appetite for our debt suppressed U.S. interest rates for 20 years. It made mortgages cheaper than they should have been. It made government deficit spending nearly painless. It allowed the U.S. government to fight wars in the Middle East and expand social programs without significantly raising taxes. because the debt was being financed cheaply by our primary trade partner. However, the geopolitical architecture that supported this trade has fractured. The catalyst was not a single event, but a slow erosion of trust that accelerated into a landslide. The initial trade tariffs imposed in 2018 were the first tremor, but the true structural break occurred with the weaponization of the US dollar in 2022, when the G7 nations froze the central bank assets of Russia, over $300 billion in reserves. In response to the invasion of Ukraine, a message was broadcast to every sovereign nation on earth. US Treasury bonds are no longer a risk-free asset. They are a political asset. If you cross Washington, your savings can be confiscated with a keystroke. Beijing, observing this, recognized a critical vulnerability. Holding $850 billion in the debt of a rival nation that is actively restricting your access to high-end semiconductors and encircling you militarily is not a strategy, it is a liability. The trade war has evolved into a capital war. The imposition of tariffs and technology sanctions, such as the bans on advanced NVIDIA chips, signaled to China that economic integration was no longer a shield against conflict. Consequently, China initiated a strategic divestment. This is not a panic sale, it is a controlled demolition of their exposure to the dollar. The data confirms this de-dollarization is happening in real time. We are seeing a structural rotation where China sells US agencies and treasuries and uses the proceeds to purchase commodities, energy reserves, and most notably, gold. They are trading paper promises for physical reality. This breaks the recycling loop. When China stops buying US debt, the United States loses its primary external funding source. But the problem is compounded because this is happening exactly when the US supply of debt is exploding. We are witnessing a divergence. The US needs to sell more bonds than ever before to fund its deficit, while its biggest customer has left the auction house. This fundamentally alters the supply and demand dynamics of the global cost of capital. To understand why this divestment translates directly into pain for the average American household, we must perform a deep dive into the mechanics of the bond market. The bond market is the bedrock of the global financial system. The stock market is merely the furniture. When the bedrock cracks, the entire house becomes unstable. The mechanism is governed by the law of supply and demand. The US government runs a fiscal deficit, currently estimated at nearly $2 trillion annually. This means the government spends $2 trillion more than it collects in tax revenue. To bridge this gap, the US Treasury issues debt securities, Treasury bonds. In a normal environment, a diverse group of buyers shows up to these auctions: pension funds, insurance companies, domestic banks, and foreign central banks like the People's Bank of China, PBOC. When a major player like the PBOC, who previously absorbed hundreds of billions of dollars of this supply, steps away, a void is created, but they aren't just stepping away, they are becoming net sellers of their existing holdings. This floods the secondary market with billions of dollars in bonds. Now, we have a situation where the US Treasury is issuing massive amounts of new debt, while China is dumping old debt. The supply of bonds skyrockets. When the supply of anything exceeds the demand, the price must fall to attract buyers. Here lies the mathematical inevitability that threatens the US economy, the seesaw effect. In the world of fixed income, price and yield are mathematically linked inverses. If the price of a treasury bond falls because there are too many for sale and not enough buyers, the effective yield, the interest rate the government must pay, rises. The market effectively demands a higher bribe to hold the debt of a profligate government. This is why we have seen the 10-year Treasury yield spike from under 1% in 2020 to hovering near or above 4 to 5% in recent volatility. Why does the 10-year Treasury yield matter to you? Because it is the risk-free benchmark against which almost every other loan in the economy is priced. The 30-year fixed mortgage rate is not set by the Federal Reserve. It acts as a spread over the 10-year Treasury yield. Historically, this spread is about 1.7% to 2%. However, due to volatility, that spread has widened. If China's selling pressure forces the 10-year yield to 6%, Mortgage rates, purely by mathematical correlation, will push toward 8% or 9%. This is not a decision made by a bank officer, it is an automatic repricing of risk. This phenomenon neutralizes the power of the Federal Reserve. We are taught that the Fed steers the economy, but in reality, the Fed is a passenger in a car driven by the bond market. The Fed can cut the federal funds rate, the overnight rate, to zero tomorrow, but if the long end of the bond market revolts, due to a lack of foreign buyers, mortgage rates and corporate borrowing costs will stay high. This is a condition known as a bear steepening of the yield curve, and it is historically associated with severe financial stress. It signals that the market has lost confidence in the government's ability to control inflation or manage its debt load without debasing the currency. Furthermore, this creates a crowding out effect. As the government is forced to offer higher and higher interest rates to attract capital, it sucks liquidity out of the private sector. Capital that would have gone into a corporate bond to build a factory or a municipal bond to build a school is instead soaked up by US Treasuries. The government effectively cannibalizes the capital required for economic growth. This is the death knell for productivity. We are entering a phase where the sheer weight of the debt supply, exacerbated by the exit of our largest foreign creditor, dictates the cost of living for every American. While the bond market repricing acts as a slow strangulation, there is a more immediate, acute risk lurking in the plumbing of the US banking system, the liquidity crisis. To understand this, we need to look at a chart that very few mainstream news outlets discuss: the overnight reverse repurchase facility, or reverse repo, RRP. Think of the reverse repo facility as the financial system's overflow tank. During the pandemic stimulus era, the system was awash in too much cash. Money market funds and banks needed a place to park trillions of dollars overnight to earn a small return. At its peak, this facility held over $2.5 trillion. This acted as a massive buffer, a shock absorber for the Treasury market. When the US government needed to sell debt, money could effectively flow out of this RRP tank and into treasuries without draining the actual reserves of the banking system. However, over the last 18 months, this tank has been draining at an alarming rate. As the Federal Reserve continues its program of quantitative tightening, QT, selling bonds off its own balance sheet, and as the Treasury issues new debt, the cash to pay for it has been coming out of the RRP. We are approaching what analysts call the red line. Once the RRP is depleted, the shock absorber is gone. The government will still need to sell bonds to fund its deficit, but the cash to buy them will no longer come from this overflow tank. Instead, it will have to come directly from bank reserves. This is the liquidity cliff. When bank reserves are drawn down to purchase government debt, it removes liquidity from the commercial banking sector. This puts immense pressure on the very foundation of the banking system. We saw a preview of this movie in September 2019 when the repo market seized up overnight, forcing the Fed to intervene. But the situation today is far more precarious because the banking system is already sitting on a massive hidden wound. This wound is the unrealized loss problem. According to the FDIC's quarterly banking profile, US banks are sitting on over $517 billion in unrealized losses on their investment securities. This happened because banks bought safe treasury bonds and mortgage-backed securities when rates were near zero. As rates rose, driven by the inflation fight and the supply dynamics we just discussed, the market value of those low-interest bonds crashed. Under current accounting rules, specifically the distinction between held to maturity, HTM, and available for sale, AFS, banks don't have to mark these losses to market as long as they don't sell the bonds. But here's the catch. Liquidity is oxygen. If the RRP runs dry and the system tightens, banks may face deposit outflows or liquidity needs that force them to sell these assets. Once they sell, the loss moves from unrealized to realized. This capital destruction is what killed Silicon Valley Bank in 2023. The banking system is currently walking a tightrope. China's selling of bonds keeps yields high, which keeps the value of the bank's collateral low. Simultaneously, the draining of the RRP removes the cushion that protected the banks from funding stress. This is a deliberate pressure point. By maintaining selling pressure on US debt, China effectively attacks the capital base of the US banking system. It restricts the ability of US banks to lend, which slows down the economy. If the Fed tries to save the banks by printing money, as they did with the Bank Term Funding Program, or BTFP, they reignite inflation. If they let the banks fail, we face a deflationary depression. The RRP draining to zero is the countdown clock to this binary outcome. We have arrived at a state of economic existence that economists call fiscal dominance. This is a regime change from everything we have known for the last 40 years. In a normal cycle, monetary policy, interest rates controlled by the Fed dominates. If the economy gets too hot, the Fed raises rates to cool it. If the economy slows, the Fed cuts rates to stimulate it. But in a regime of fiscal dominance, the sheer size of the government's debt pile and the interest payments required to service it override the central bank's tools. The math is unforgiving. With US federal debt crossing $35 trillion, a 1% increase in interest rates adds roughly $350 billion to the annual deficit merely in interest service costs. We are already currently spending more on interest payments than we do on the entire defense budget. This creates a doom loop. The government has a deficit, so it borrows. Borrowing pushes rates up. Higher rates mean higher interest payments. Higher interest payments increase the deficit, so the government must borrow even more. The cycle accelerates exponentially. The Federal Reserve is trapped in a checkmate position. They have two choices and both are catastrophic. Option A, fight inflation. To do this, they must keep interest rates high and continue quantitative tightening. However, as we've established, high rates threaten to blow up the banking system via unrealized losses and the housing market, while making the government's interest bill mathematically insolvent. This path leads to a deflationary sovereign debt crisis, a default in all but name. Option B, financial repression. The Fed pivots. They accept that they cannot let the government go bankrupt. They turn the money printers back on to buy the debt that China and others are selling. They might call it yield curve control, as they did in the 1940s, or market functioning support. Regardless of the branding, it is monetization of debt. This saves the bond market and the banks in nominal terms, but it destroys the currency. It unleashes a second, more virulent wave of inflation. History tells us which path politicians invariably choose. Deflation is painful and visible. People lose jobs and homes immediately. Inflation is insidious and gradual. People keep their jobs, but their paycheck buys less every month. Political incentives always align with inflation. They will choose to print, they will choose to debase the currency to pay off the debts. This is the calculation Beijing has made. They are betting that the US will be forced to inflate away its debt, eroding the value of the dollar holdings of anyone foolish enough to keep them. By selling now, China is exiting the theater before the fire exits are jammed. They are front-running the inevitable pivot of the Federal Reserve toward permanent monetization. This puts the US dollar in a precarious position, not just as a store of value, but as the reserve currency of the world. The attack on the dollar's hegemony is not limited to the bond market. It is a multi-front assault. For half a century, the US dollar's value was underwritten by the petrodollar system. This was an informal but ironclad arrangement born in the 1970s. The US provided security guarantees to Saudi Arabia, and in exchange the Saudis priced oil exclusively in US dollars. This forced every nation on earth to hold dollars in reserve to purchase energy. It created a permanent structural demand for US currency that allowed us to export our inflation to the rest of the world. That monopoly is eroding. While reports of the death of the petrodollar are often exaggerated, there was no formal treaty that expired. The trend is undeniable. Saudi Arabia has explicitly stated its willingness to trade in currencies other than the dollar, joining the M-Bridge project, a central bank digital currency platform designed to facilitate cross-border trade without touching the US banking system. China is now purchasing significant amounts of energy from Russia and the Gulf states using the yuan. This is a direct reduction in the global demand for dollars. Simultaneously, We are witnessing a historic accumulation of gold by central banks, led by the People's Bank of China. According to the World Gold Council, central bank gold buying has hit rates not seen since the late 1960s, right before the collapse of the Bretton Woods system. Why gold, and why now? Because gold is the only reserve asset that is not someone else's liability. It has no counterparty risk. It cannot be frozen by the U.S. Treasury's Office of Foreign Assets Control, OFAC. This is the pincer movement. 1. Supply shock. China dumps U.S. treasuries, forcing U.S. rates up and destabilizing the U.S. fiscal position. 2. Demand collapse. The move to settle energy trade in non-dollar currencies reduces the global need to hold greenbacks. This squeezes the U.S. economy from both ends. It diminishes the exorbitant privilege that allowed Americans to consume more than they produced for decades. The result is a secular decline in the purchasing power of the dollar. We are moving toward a multipolar financial world where the dollar is one of several blocks, rather than the sun around which the solar system revolves. For the American saver, this means the cost of imports, everything from coffee to cars, will rise structurally over the coming decade. So what does this mean for your portfolio? The traditional 60-40 portfolio, 60% stocks, 40% bonds, was designed for a world of falling inflation and falling interest rates. That world is gone. In an environment of fiscal dominance and structural inflation, bonds cease to be a hedge against stock market volatility. Instead, stocks and bonds become positively correlated. They crash together. We saw this in 2022, and we will see it again. To survive this transition, one must adopt the mindset of a central bank, not a retail investor. You must look at what the smart money and sovereign entities are doing, not what they are saying. Hard assets and commodities. If the currency is being debased to service the debt, you want to own things that cannot be printed. This includes energy infrastructure, agricultural land, and industrial metals like copper and lithium needed for the energy transition. These assets have intrinsic value and tend to reprice upward as the currency devalues. 2. Monetary metals, gold and silver. This is not just a trade, it is insurance. However, the distinction between paper gold, ETFs, and physical bullion is critical. In a true liquidity crisis, counterparty risk becomes the primary danger. China is taking physical delivery for a reason. They want the asset, not the promise. 3. Fixed-rate debt elimination. If you hold a 30-year mortgage at 3%, you have an asset. You are effectively short the dollar. But if you hold variable rate debt, you are vulnerable. The volatility in the bond market will translate to credit card rates and adjustable loans. Paying down variable debt is a guaranteed risk-free return equal to the interest rate you are saving. 4. Jurisdictional diversification. Just as China is diversifying away from the dollar to reduce political risk, individuals should consider diversifying their exposure. This doesn't necessarily mean moving abroad, but it means holding assets that are not entirely dependent on the performance of the U.S. financial sector. The China sell-off is not the end of the world, but it is the end of an era. It is the end of cheap money, cheap goods, and the automatic dominance of the U.S. dollar. The volatility we are seeing is the market trying to find a new equilibrium. Those who understand the plumbing, the relationship between bond yields, liquidity, and real assets, will position themselves to preserve purchasing power. Those who remain passive, relying on the strategies of the last 40 years, will find their wealth transferred to the holders of hard assets via the invisible tax of inflation. The $850 billion figure is just the headline. The story underneath is about the fundamental restructuring of the global financial order. The bond market is screaming that the math no longer works. The Fed is cornered. The liquidity that greased the wheels of the economy for a decade is drying up. We are entering a period of high volatility where the rules of the past, buy the dip, trust the 60-40, rely on the Fed put, are being rewritten. The most dangerous thing you can do right now is assume that the next 10 years will look like the last 10. They won't. If you want to dive deeper into the specific indicators that signal when the Fed will be forced to print, the red line chart that predicts the pivot, make sure you're subscribed. Understanding the timing of the liquidity cycle is the difference between getting crushed by the waves or surfing them. Stay skeptical, stay prepared, and pay attention to the plumbing. If you found value in this deep dive, hit the like button to help the algorithm share this financial education. And if you want to see the specific chart that tracks the exact moment the liquidity crisis will force the Fed's hand, click the video on your screen right now. I'll see you there.